Most people build their portfolios around ETFs with impressive names, long track records, and familiar logos. They check all the obvious boxes. But here's what nobody tells you. That pretty solid choice might be quietly draining $500,000 from your future, along with over $70,000 in dividend income you'll never see coming. So that's exactly what we're breaking down today. I've taken 5 well-known ETFs, including one you've probably heard recommended more times than you can count, and put them head to head. We're looking at everything that actually moves the needle over time: total returns, dividend income, fees, risk exposure, and portfolio quality. Some of these are genuinely strong funds, but one of them, it separates itself completely. I'll walk you through why later in the video, and at the end, I'll show you how putting just $7 a day into the top pick could build you a portfolio worth nearly $1 million and generate over $70,000 in yearly dividend income.
What is an ETF really? Before we get into the rankings, let's make sure we're working from the same foundation, because once the basics click, everything else makes a lot more sense. Think of an ETF like a grocery cart you fill with stocks. Instead of picking companies one by one, you're buying an entire collection in a single transaction. And just like any regular stock, you can trade it throughout the day on the open market. Some ETFs are built for growth. They load up on companies expanding fast. Others are built for income, targeting businesses that hand out steady cash through dividends. But the type we're focused on in this video, dividend ETFs that do both. They pay you today and build your wealth tomorrow. Here's the nuance, though. Not every dividend ETF operates the same way. Some gravitate toward big, slow-moving companies with multi-decade dividend histories. Others hunt for undervalued sectors like utilities, banks, and energy. Each carries its own risk-reward balance, and knowing the difference is what separates smart portfolio decisions from expensive guesses.
How I'm picking the best. Before we rank anything, let's talk criteria. Because 2 ETFs can look almost identical on the surface and perform worlds apart underneath. First, total return. This isn't just about how much the share price climbed. It's growth plus dividends combined, especially when you're reinvesting those payouts over time. That compounding is where the real wealth gets built. Next, dividend yield and dividend growth. How much cash is the fund throwing off every year? And is that amount going up year after year? A fund that pays well today but never increases that payout starts losing ground to inflation. Then there's risk. How much does this thing swing up and down? How did it hold up when markets fell apart? Does it recover fast or does it stay underwater? Expense ratio. This is the fee you're paying just to hold the fund. Over 20 or 30 years, even a tiny difference compounds into thousands of dollars gone. Lower is better, always. And finally, the quality of the companies inside the fund. Are we talking financially strong businesses with durable profits or shaky ones propped up by hype? Those are the filters I'm using. Let's get into the funds. ETF number 1, SPY, Spider S&P 500 ETF Trust. Ticker SPY. If you've been around investing for more than 5 minutes, you've heard of this one. SPY launched in 1993 as the very first ETF listed in the United States, and it's never looked back. What it does is beautifully straightforward. It tracks the S&P 500, meaning a single purchase gives you exposure to 500 of America's largest companies across tech, healthcare, finance, and virtually every other sector. Performance-wise, SPY has earned its reputation. Over the last year, it's up around 12.77%. 5-year return sits near 95%, and over a full decade, it's delivered a staggering 201.94%. For a fund that just mirrors an index, that's a genuinely elite track record. The expense ratio is a rock-bottom 0.09%. You're essentially paying nothing to own a slice of the American economy. Its dividend payout is $7.17 per share, but income generation isn't really SPY's purpose. This is a capital appreciation machine. With $645 billion in assets, SPY is one of the most liquid investments on the planet. Buying and selling is frictionless. You get in and get out without losing money to the spread.
The top holdings read like a who's who of the modern economy: NVIDIA, Microsoft, Apple, Amazon, Meta, Tesla, and Alphabet. Technology dominates at 35% of the portfolio, reflecting where the economic gravity sits right now: AI, cloud computing, software. On the risk side, SPY's standard deviation sits around 12.6, which is actually slightly below average. It doesn't bounce around wildly. The turnover rate is just 3%, so it's not constantly shuffling positions. And its tracking error is minimal. It follows the S&P 500 like a shadow. Bottom line, SPY is a powerhouse for long-term growth. But if income is part of your financial plan, this fund will leave you wanting more. ETF number 2, VIG, Vanguard Dividend Appreciation ETF. Ticker VIG. If VIG takes a different approach, rather than chasing the highest yields, it homes in on one specific quality: companies that have consistently raised their dividends year over year. That disciplined focus has made it a cornerstone holding for investors who want steady, reliable growth without a lot of drama. Returns have been solid, if not spectacular. 1 year, up 8.67%. 5 years, 68.46%. 10 years, 161.94%. Nothing flashy, but the ride has been smooth and the direction has been consistently up. The dividend payout is $3.52 per share. Modest compared to higher yield alternatives, but the trajectory of that payout is what matters. It keeps climbing. The expense ratio is an industry-low 0.05%, which is almost nothing. VIG manages nearly $110 billion in assets, making it one of the biggest dividend-focused funds around. Its holdings span technology, financials, healthcare, consumer staples, and industrials, a solid recession-resilient mix. Top names include Broadcom, Microsoft, JP Morgan Chase, Apple, and Visa.
Risk profile is calm, standard deviation of 11.69, the least volatile fund on this list. With only about 32% of the portfolio concentrated in its top 10 holdings, single company blowups don't hurt much. The catch? VIG plays it safe to a fault. The yield is low, the growth is measured, and for investors who need their portfolio to generate real spendable income, VIG's conservatism becomes a ceiling. ETF number 3, VOE, Vanguard Mid-Cap Value ETF. Ticker VOE. VOE occupies the middle ground. It's not aggressive, but it's not sleepy either. It targets mid-cap companies that appear undervalued relative to their fundamentals. Businesses trading below what their earnings and assets suggest they're worth. The pitch is built-in downside protection combined with meaningful upside potential. 1-year return, 5.62%. 5 years, 67.15%. 10 years, 86.18%. Consistent but not leading the pack. The dividend rate is $3.72, paid quarterly. Expense ratio, 0.07%, impressively cheap. Total assets under management, $30.57 billion. Sector breakdown leans heavily into financials, 17%, industrials, 13%, utilities, 12%, consumer staples and technology, with a real estate allocation as well. It's diversified across economically sensitive and defensive sectors alike. From a risk standpoint, the standard deviation is 14.43, a bit above average. The turnover rate is 19%, and the 1-year tracking error is 9.37%. VOE is a fine fund, but fine is also its ceiling. It doesn't lead in any category, not income, not growth, not stability. It's the kind of fund you hold because it's not bad rather than because it's exceptional. ETF number 4, DVY, iShares Select Dividend ETF. Ticker DVY. DVY isn't trying to grow your wealth, it's trying to pay you. This is the income specialist of the group, designed for investors who want consistent cash flow, not capital appreciation. Retirees and near retirees tend to gravitate here. Returns reflect that priority. 1 year, up 5.11%. 5 years, 62.67%. 10 years, 80.14%. Not impressive growth numbers, but again, that's not the mission. What DVY does deliver is income.
The trailing 12-month dividend rate is $5.15 per share, paid quarterly. Expense ratio, 0.38%, higher than the others, but still reasonable given the fund's specialized focus. Total assets, nearly $20 billion. DVY holds about 107 U.S. companies, and more than half the portfolio sits in just two sectors, financials and utilities. Consumer staples, energy, and communication services fill out the rest. Tech barely registers at 4.5%, and that's intentional. This fund avoids volatility and sticks with predictable income producers. Think Ford, Altria, Pfizer. The standard deviation is 15.38, the highest on this list. It moves around more than you'd expect from an income fund, though the 19% turnover rate means it's not aggressively trading. It buys and holds, just like the investors who own it. If steady cash flow is the entire goal, DVY delivers, but you're trading away diversification, growth potential, and long-term wealth building to get it. ETF number 5, SCHD, Schwab US Dividend Equity ETF. Ticker, SCHD. Here's where the conversation shifts. SCHD has built a loyal following among serious dividend investors, and when you look at what the fund actually does, it's not hard to understand why. It doesn't ask you to choose between income and growth. It gives you both. The past year has been a rough patch. SCHD dipped about 1.09%, but one difficult year doesn't tell you much about a fund built for decades. Zoom out and the picture changes entirely. Up 52.61% over 5 years, 113.93% over 10. That's where SCHD builds serious wealth through patient, compounding growth over time. What really separates SCHD is how selective it is. To earn a spot in this fund, a company has to clear a high bar, at least 10 consecutive years of dividend payments, demonstrated profitability, a strong balance sheet, and a genuine track record of rewarding shareholders. That screen cuts out the flaky stuff and keeps the quality high.
Sector exposure lands heavily in energy, consumer staples, and healthcare. Businesses that sell essential goods and maintain profitability through economic turbulence. There's also meaningful exposure to technology and industrials, while volatile sectors like utilities and basic materials are almost entirely absent. Top holdings include Texas Instruments, Chevron, PepsiCo, and Merck, large, stable companies with long dividend histories. The top 10 holdings make up about 40% of the fund, and total holdings reach 103 companies, giving you focused diversification rather than scattered diversification. Risk profile: standard deviation of 14.64, turnover rate of just 29%, 5-year tracking error of 9.78%. Disciplined and steady, exactly what you'd want in a long-term core holding. Head-to-head, which one actually wins? Now let's lay all 5 side by side and see what the numbers actually say. SPY is the king of capital growth. It's proven, broad, and dominant over time. But its dividend output is minimal. If your end goal includes living off portfolio income, SPY doesn't get you there. VIG is quality-focused and consistent. Dividend growth is its strength, but it plays so conservatively that yield stays low and overall returns trail the others. Dependable, yes. Exciting? Not quite. VOE offers value exposure and decent diversification, but it doesn't lead in any single category. The growth is soft, the income is middle of the road, and the risk creeps a little higher than you'd expect. It's a perfectly acceptable fund without a compelling reason to choose it over the others. DVY is the income machine. If you need the highest possible cash flow and nothing else, it's purpose-built for that. But the trade-off is real: limited growth, sector concentration, and a portfolio that isn't building much wealth in the background. SCHD is the one fund that makes you stop making trade-offs. It delivers SPY-level long-term performance with actual dividend income along the way. It matches VIG's commitment to quality with better yield and stronger upside. It applies VOE-style value discipline with better companies and tighter risk controls.
And it generates DVY caliber income with smarter diversification and genuine capital appreciation underneath it all. That's not a coincidence. It's what SCHD was designed to do. What $7 a day looks like over 30 years. Let's make this real. Not a lump sum investment, not some figure most people can't picture, just $7 a day. The cost of a sandwich, a streaming subscription, a daily coffee. With SCHD's dividend yield of 3.75%, historical dividend growth rate of 10.77%, and average annual share price appreciation of 7.61%, here's how that $7 a day compounds over time. Year 1, around $2,555 invested. Year 10, portfolio value around $45,000, annual dividends around $2,000. Year 20, portfolio value around $229,000, annual dividends around $12,000. Year 30, portfolio value around $953,000, annual dividends around $75,000, approximately $6,250 per month. All from $7 a day. Now let's look at how the other 4 ETFs compare over the same 30-year period, investing the same $7 daily. VOE comes in at a final portfolio value of roughly $450,000. Solid, but the conservative posture limits how aggressively wealth compounds. VIG finishes at approximately $530,000. Steady growth, but the low yield means income never really takes off. DVY edges ahead slightly at around $528,000. The higher income helps initially, but limited growth means it plateaus in the middle of the pack. SPY delivers around $650,000. Strong capital appreciation, but minimal dividend income to show for it. And SCHD? $953,000, nearly $500,000 more than the lowest performer, and almost $350,000 ahead of the second-best fund in the group. The income gap is even more dramatic. After 30 years, SPY generates roughly $1,000 per year in dividends. VIG produces about $4,000. VOE reaches around $22,000. DVY, the supposed income specialist, tops out near $31,000 annually.
SCHD generates $75,000 per year, every single year. That's over $44,000 more per year than DVY. That's over $74,000 more per year than SPY. That's not a minor difference. That's the difference between a portfolio that pays you and one that could fund your life. If you want to see how a one-time $500 investment can eventually produce over $5,000 in monthly dividend income, click the next video on screen to find out.